Herzlich willkommen, liebe Zuschauer, zu Inside Wall Street vom Parkett der New Yorker Börse. Bei mir zu Gast ist heute Ben Willis von Albert Fried Company. Ben, thank you for joining us.
Pleasure to be here. Thank you.
JP Morgan Chase and Wells Fargo impressed with its earnings. How do you see this data?
Well, the market sees it negatively. JP Morgan seemed to have massaged their numbers with a release of some reserve numbers. Wells Fargo, I thought was impressive. The market didn't quite think so. So, not a surprise. The expectations were, the whisper numbers were slightly better. So the stocks themselves, at least initially, came off. But they've had a great run. You have to take that into consideration. I view it as a positive for the overall market. I believe the market has run too far too fast and needs to come back a little bit. Every dip we've seen in the last few weeks has been met with buying, whether it's European buying or U.S. retail investor buying. The fact of the matter is, for a healthy market, in order to be higher by the end of the year, we need to come in a little bit, and we have not seen it, for me, a significant enough correction.
Last week, Alcoa started. What do you expect for the next days and weeks?
Well, I think the most important data to watch actually will be the central bankers' conversations on how they're handling it. I think the movement by the Bank of Japan has been underestimated on its impact in the world because the bond markets are trying to price in what has been a historic movement by a central bank, and we're not quite sure. The Japanese bond market has halted for trading several times because of the volatility and trying to reprice this new paradigm, if you will, in Japan. In the United States, we keep getting these cross currents of the different Fed governors, whether they're going to cut rates or back away from the quantitative easing. You know, on Friday we had another Fed governor saying they haven't done enough to ease. He would like to see it more. So, and I think that's having an impact on the overall market. So if I were looking at anything, I would like to keep an eye on particularly the central banks out of China, because of their lending situation there. We're getting, again, some different indications of whether they're lending too much or not enough. Bank of Japan and the United States. The euro, that's so confusing. If you want to keep an eye on anything, keep an eye on Germany inside the euro. The rest of it is incredible noise to try and trade around.
Back to the earnings season, what do you expect for that?
Well, I'm not an analyst, just to be clear on that. I think the expectations has been lowered dramatically. So I think you can continue to look for eventually the overall picture that most of the listing companies will beat their much lowered expectations. The question is how that will fit in the regular flow of the market. You know, we all talk about Alcoa and how it affects the market. The fact of the matter is Alcoa is no longer a bellwether indicator. They reported good earnings this quarter, but their earnings over the last several years have diminished in value to the broad market indication because, quite frankly, they've lost to China. China Incorporated has beaten Alcoa into a non-event, if you will. So if you're interested in the basic material groups, you have to keep a closer eye on what's going on in China and their use of the basic material groups than Alcoa.
You already mentioned the QE3 program. Some analysts say the program has to be end at the end of the year. What do you think?
Well, I don't know which way they're going to, when exactly their timeline is. We know that eventually they have to end it. We can't go on into zero interest rates forever, as much as some people would hope that was going to happen. So my interest as a trader and as an investor is how the central bank of the United States is going to manage those expectations. The problem was the first time we had a whisper that they were going to back away, pull the punch bowl away from the party, so to speak. The markets did not react the way the Federal Reserve thought they were going to react. We had a rather demonstrative drop in the 10-year yield. So if you want to keep an eye on how the markets will react, keep an eye on the 10-year yield and how that will happen. I think actually it will be a positive for equities, which is why I don't tell anybody, I don't manage money, just friends of mine that ask me. I would not have any exposure to U.S. Treasuries in this market. I would be in stocks. I may be in, if you want fixed income exposure, some high dividend paying stocks or something like the master limited partnerships or real estate investment trusts. The interest rate risk in the particularly U.S. Treasury, to me, is frightening. I think the Federal Reserve has in fact created a bubble, and they're trying to figure out a way to deflate it rather than pop it.
The stock market or the Dow Jones is on a very, very high level at the moment. Where do you see the Dow Jones at the end of the week?
I would like to see it lower. again, going back to my theme that, but I, quite frankly, have been wrong. Every time I think we're finally going to get that correction, the wave of money that comes into this market, it's not very aggressive, but there are bids everywhere you look when there's any kind of pressure. As it was demonstrated on Friday, we started the morning after economic data much lower, and by the time we opened, we were actually a little bit higher. The expectations were met. So until we break that buy the dip mentality, my concern is that we may very well be higher because there is no resistance to the upside from a technical analysis point of view. But every time we have a dip of more than 1%, there seems to be plenty of money to buy it.
Ben Willis, thank you very much for the interview. Und Ihnen, liebe Zuschauer, danke ich fürs Einschalten. In der nächsten Woche begrüßt Sie hier dann wieder Manuel Koch. Ich wünsche Ihnen noch einen schönen Tag. Machen Sie es gut. Bis zum nächsten Mal.